Welcome all. In this session, we are going to discuss in detail about the reinsurance. So far, we discussed on the life insurance, general insurance and its various classifications like fire insurance, marine, motor and other miscellaneous insurances. Now, we go into reinsurance. What do you mean by reinsurance? A reinsurance is nothing but a sub-insurance. When an insurer transfers a part of his risk on a particular insurance by insuring it with another insurer, this is called reinsurance. As such, reinsurance is a contract between two insurance companies, that is, between the reinsurer and the first insurance company. Now, let us discuss on the origin of reinsurance. The idea of reinsurance system is believed to have originated in 1853 in Germany with the corporation of Cologne Reinsurance Company. This company developed and spread the system over to other European countries. Later on, in 1907, another reinsurance company came into existence, namely Mercantile and General Funded. In India, the Insurance Act 1961 made compulsory for the insurance to get reinsured certain percentage of their Indian business on a quota share basis, with the two professional reinsurers, namely India Reinsurance Corporation Limited and Indian Guarantee and General Insurance Company Limited. But with the nationalization of general insurance business in India in 1972, the reinsurance powers are vested with the General Insurance Corporation of India. The insurers may reinsure the balance of risk not insured with GIC with other Indian insurers on reciprocal basis. We can have some more explanation on this. A reinsurance is a contract between two insurers, that is, an original insurer who is called direct insurer and another insurer who is called reinsurer. Thus, reinsurance is the insurance of insurance. Reinsurance is an extension of the basic principle of insurance, that is, spreading the losses of the few over the many, so that heavy loss of one person is spread over many insurers. But reinsurance may not always be affected to spread or share the loss with other insurers. Sometimes an insurer may undertake the insurance of certain risks at a higher rate of premium and may reinsure a part of these risks with some other insurer at a lower rate of premium with a view to making out profit from the difference between two premiums. However, whatever may be the purpose of reinsurance, the original contract is never superseded and replaced by any reinsurance contract. Reinsurance can be applied in all types of insurances. The insurer has an insurable interest in the subject matter insured to the extent of the amount insured by him. Reinsurance contract is also a contract of indemnity and the reinsurer is bound to pay the amount of loss to the original insurer only if the direct insurer has paid the amount to the insured. Reinsurance is the transfer of a part of the risk by the insurer to another insurer. It is an arrangement between two insurance companies by way of which the original insurance company or insurer who has insured the risk insures a part of that risk again with other insurance company in order to reduce his own liability. A reinsurance is done to reduce the own liability and transfer of a risk and a liability to another insurer. The difference between the retention and the total amount of acceptance is reinsurance. It is the distribution of risk and to secure full advantages of principle of average. Say for example, X company accepts a risk of rupees 5 crores and transfers a part of it, say rupees 2 crores, to another Y company. X company is the original company who underwrite the risk of rupees 5 crores. Y company is the reinsurer to whom X company has transferred its risk. The contract of reinsurance is between two insurance companies. The insured is not concerned with this contract of reinsurance. The insured has no right to make any claim from reinsurer in case of loss. Now, you will be very curious in knowing what are the differences between these two, that is insurance versus reinsurance. There is always a separate arrangement between the original insurer and the reinsurer, but sometimes the contract is based on the same terms and conditions as contained in the original policy, but there is a difference between reinsurance and insurance. The points of differences are: there is no contract between the insured and the reinsurer, as the agreement is between only the insurer and the reinsurer. The contract is between insurers alone. The insured has to seek compensation for the loss of property from the original insurer. Only original insurer has to indemnify the loss and can be demanded the share of contribution from the reinsurer. The original insurer has to accept the liability and ensures the presence of insurable interest. Let us see the characteristics of reinsurance. Reinsurance contracts belong to the class of liability insurance, and it undertakes or secures the risk of liability of the direct insurer only. The reinsurer shall never be liable to the original insured. A reinsurer is liable only for the risk or any part of a risk as expressly mentioned in the reinsurance contract. The principles of an insurance contract are also equally applicable on reinsurance contracts such as utmost good faith, insurable interest, law of subrogation and indemnity, etc. Reinsurance contract does not affect the rights, obligations of the original insured, but the reinsurance contract is subject to all the conditions in the original policy, and the reinsurer is entitled to all the benefits to which the original insurer is entitled under the original policy. The contract of reinsurance is in fact coexistence with the original contract. For example, if for any reason the original contract comes to an end or is voided, the contract of reinsurance also comes to an end. Direct insurer can never reinsure larger amount than he has originally insured. As such, when the sum assured exceeds the retention limits, the surplus so exceeding will have to be reinsured. The direct insurer is indemnified only when a liability has been created on account of the loss of the original insured. On payment of a loss under the policy of reinsurance, the reinsurer is subrogated to all rights of the original insurer, which may include the rights of the insured to which the original insurer is subrogated. Reinsurance can be resorted to in all types of insurance. Shall we move on to objectives of reinsurance? The Federation of Insurance Institutes, Mumbai, has laid down some important objectives of the reinsurance system. Let us see one by one. Wider distribution of risk to secure the full advantage of the law of average and to safeguard the interest of insurers. Then, a limitation of liability of the insurer to an amount which is within his financial capacity. The stability of underwritings over a period of time, that is generally equal distribution of risks. A safeguard against serious effects of uncertainties such as flood, drought, widespread sickness, riots, war, etc. A sound system of retentions and reinsurance to assist in steady accumulation of reserves by the insurer. Besides these, sometimes an insurer may undertake the insurance of certain risks at a higher rate of premium and may reinsure part of this or whole of it with some other insurers at a lower rate with the objective of earning profit out of it. That is, making profits by way of retaining the difference between the two premiums. Shall we discuss the rights of reinsurer one by one? The reinsurer is entitled to get a proportionate share of the premium from the original insurer for undertaking the risk. The reinsurer can get the benefits of the terms and conditions of the original policy. The reinsurance is also a contract of indemnity. The original company must disclose all material facts to the reinsurer at the time of loss. The reinsurer indemnifies the loss up to the amount of reinsurance only. Reinsurance company is entitled to right of subrogation. Reinsurance come to an end, its original policy lapses and comes to an end. Liabilities of reinsurer. The reinsurer is liable to pay the proportionate share of loss to the original insurer in case of partial loss. The principle of subrogation applies on reinsurer in this case. It is useful to fix the limit up to which the insurer is prepared to lose on the risks in the specified class. The limits of loss depends on some circumstances, nature and size of the concern. The liability of the reinsurer depends on the nature and size of the concern proposing for insurance. Then location. The liability of the reinsurer also depends upon the amount of risk taken by the reinsurer, and it depends upon so many factors like location of subject matter and other related factors. Then financial status. The insurer can only take the risk according to its financial status. The new insurer with a small premium income cannot take the large risk because he cannot afford to sustain loss which might occur at any time. But the established insurer with a large premium income can take high risk because of good financial status and high reserves. Then experience. The experience of the insurer also limits its liability. The experience in particular class of risk, like the degree of the fire hazards present, the extent of the damage likely to be sustained and the fire extinguishing facilities available, limits the risk taking ability of the insurer. Shall we go into the principles of reinsurance? Reinsurance is the transfer of insurance business from one insurance company to another insurance company or insurer. It is contract between the original insurer and the reinsurer. It is a contract of indemnity also. The principle of insurance are applicable on reinsurance also. These are principles of utmost good faith. The principle of utmost good faith is applicable in reinsurance contract also. In original insurer, the insurer must maintain good faith in regard to subject matter of insurance as it is between insurer and the insured. Then principle of indemnity. The contract of reinsurance is the contract of indemnity. In case of loss of subject matter, the reinsurer indemnifies the loss up to the reinsurance to the original insurer because the original insurer has indemnified the loss of insured. Then principle of insurable interest. The acceptance of the risk and liability by the original insurer is enough and considered as the presence of insurable interest in subject matter of the part of original insurer. Students, you may have a question that how much should retain and how much should be reinsure. In fact, every insurer has a fixed limit of retention of risk that he can undertake conveniently according to his capacity. But continuous offers of profitable ventures become a routine matter, and as such he sometimes undertakes more risk than he can conveniently bear. Then, in order to safeguard his own interest, he may insure the same risk either wholly or partly with some other insurer. Retention is the amount of risk liability retained by the original insurer out of the maximum amount of liability assumed on a particular risk. The balance amount of risk liability transferred to the reinsurer is known as cessation. For example, X Limited accepts the risk of rupees 5 crores and transfers a part of risk, say for rupees 2 crores, to Y Limited for reinsurance. X Limited is the original insurer and Y Limited is the reinsurer. The balance of risk of 3 crores retained by X Limited is called retention, and the risk of 2 crores transferred to Y Limited is the amount of cessation. Do you know what are all the reasons for reinsurance? There are so many reasons for reinsurance, but the basic reason of reinsurance is the transfer of risk by original insurer to reinsurer. The first and foremost reason is transfer of risk. The insurance company or insurer generally set the limits up to which extent they are ready to accept risk. These limits are based on the financial status of a particular insurance company. It is very difficult for an insurer to go beyond that limit. Sometimes the state of legislations also impose the limits in fire insurance. The insurer do not want to insure certain hazardous risks which involve large possible losses. In such cases, the insurer transfers a part of risk to the reinsurer without losing any business. In this case, the reinsurer gets commission and reinsurance premium from the original insurer. Then, expansion of business. Reinsurance helps in the expansion of the business. It is a common practice in some countries to accept reinsurance business. They accept a risk transferred to them by other companies and have flourished due to the facility of accepting reinsurance business. Then, increase in profit. Reinsurance generally results in a net gain to the reinsurer. The reinsurer receives adequate premium to underwrite reinsurance risk and save cost of issuing policies and gain financially in assessing loss payments. This way, the reinsurer increases his profits. Then, for the sake of goodwill, a company with adequate reinsurance facilities command better goodwill than the one without it, because several companies involve the protection against a particular risk. The better goodwill results into better business and more profits. Do you know what are all the advantages of reinsurance? It increases insurance business. Reinsurance is one of the main reasons of development of insurance business. Reinsurance enables every insurer to accept or underwrite insurance business, as the total risk will automatically distributed among other reinsurers. Thus, reinsurance helps in increasing the volume of insurance business because in its absence every insurer will hesitate to accept huge risk, and it would have rather been very difficult for an insurer in case he accepts risk exceeding his capacity. For best distribution of risk, reinsurance makes the best possible distribution of risk among various insurers. Concentration of larger risk on a particular insurer or insurance company makes it harder to function smoothly, efficiently and profitably. And reinsurance contributes a lot in this respect by making best distribution of risk of many insurers. It enhances insurers' goodwill. The financial capacity and risk bearing capacity of the insurer increases with the aid of the reinsurance. With the aid of reinsurance, with the existence of reinsurance facilities, an insurer can accept a risk beyond his capacities. He can always say yes, and there is no room for no in accepting even larger risk, which enhances the dare and goodwill of the insurer. Then stability in premium rates. Generally, premium rates are fixed in accordance with the facts available regarding the past losses experience of the risk concerned. The insurer, with the help of reinsurance, can work in a comparative manner, thus may collect larger statistics regarding past losses and thereby can fix premium rates for different classes of risk by mutually agreeing on the issues. All this helps in bringing about the stability in premium rates of different classes of risk. Then it is helpful, it curbs the competitions and rivalries. Reinsurance reduces intercompany business competition as no one works independently, but in cooperative manner and with helping mind in the field of insurance business. Thus, reinsurance helps in curbing the competition rivalries among various insurers operating in the similar line of insurance business. Then, stability in the profits of insurance companies. Reinsurance is beneficial to small insurers or recently established or new entrants, as it automatically provides them insurance business. Secondly, reinsurance helps in bringing stability of profits of existing insurance companies as number of policies issued by them increase with reinsurance facilities. Insurance business is regularly and automatically received in the form of reinsurance business consisting of small risk as well as good risk over a long period of time, which stabilize the profits of the insurer. Then it protects insurer's interest. Reinsurance has been considered to be a special arrangement to obtain reinsurance protection for a particular type of business of original insurer. Reinsurer ensures automatic protection to the insurer as excess business over the maximum limit of retention can be undertaken by the reinsurer, thus reducing the insurer's total liability. Then advantage to the insured. It also helps the insured as it enables him to get larger risk underwritten with a single insurer. Otherwise, he has to approach at his personal level different insurers. As such, it relieves the insured from the burden of getting huge risk insured from different insurers. Similarly, in case of loss, he can receive compensation only from the original insurer, as he has not to do anything with the reinsurers. As such, reinsurance helps an insured to strengthen his financial position as it saves time, labor and overhead expenses which would have been incurred for getting different policies for a single large risk. So far we discussed the various dimensions of reinsurance. Let us see annuity and surrender value of insurance in the coming session. Take care. Have a good day.